The panel that we're going to have now is the PwC Report on Financial Advice in the Industry. Consumers of financial products are increasingly relying on their professional advisors to provide them with a wide range of financial services that address their changing needs as they move through their life cycle. The analysis completed for the advisors for their clients will result in an assortment of recommendations tailored for risk mitigation, wealth accumulation, and preparations for a comfortable retirement. To date, this has not been what has been investigated is the contribution of professional advice to the overall health of the Canadian economy. Members of this panel will focus on the research conducted by PwC as it relates to small and medium-sized financial advice businesses in Canada. And the panel will look into the structures of these businesses as well as the economic contribution for professional advisors in the Canadian economy. Our moderator is going to be Barbara Schechter, and the panelists will be Byron Ennis, Davis Yu, Dennis Bruce, and Peter Zanatakis. But as you've become aware, there's something more to be said than what's in their introduction. So let me introduce Barbara Schechter to you. That she's actually a qualified elementary school teacher and often finds herself on the learning end of things in her current occupation as a journalist. Even more surprising is that if you had a conversation with her, you'd see that she was qualified to teach French. So it's most interesting and we're most helpful. You will be surprised if I speak French to you, because I'd be surprised if I spoke French to you. I'm pleased to also introduce Byron Ennis, who has been an avid wine collector for nearly 25 years and travels to the wine countries around the world each year. Where there's no vineyards, there'll be no Brian. Oh, no, that's not what he said. Brian relocated to the Barbados almost 3 years ago and now does a long-distance commute to Toronto to take care of his clients. And quite fascinating to think that we complain about our commutes in these cities, and he's coming from the Barbados. So, growing up in Victoria, he can't skate and wears the most boring of socks. So that's something to look for while he's sitting up here in the panel. I'd like to introduce Davis Yu, who, like many Canadians, loved golf, and when his career in the financial services industry offered him an opportunity for pause, bought a retail golf distribution company and became very successful in the golf industry before selling it out to a private equity firm and applying his natural business talent and golf acumen to the PwC consulting world. He's not very good with directions. We lost him at the restaurant last night, and that's something that'll stick in my mind probably forever. And thank goodness he made the boardroom this morning so that we're actually in the right place with him. Dennis Bruce is our next panelist, and he has 4 children that were born within 3.5 years of each other. I think that's 4 under 4 is what I'm not sure if that's 3.5 between each of them, which would be less interesting, but we'll go 4 under 4. And we're glad that you could find a few moments here to come and see us. The last is Peter Zanatakis, who's a favored member of the Advocis team, we all know. And while you guess easily that Peter is Greek from his name, which you probably, not the Peter, by the way, the Zanatakis is what makes you think he's Greek. What you probably don't know is that he's actually follows the ancestry of a Spartan and is quite proud of that. If you know the history about Sparta or have seen the recent Hollywood films or the ancient war state, you'd agree we're glad he's on our team and not others, and I'm looking forward to the Spartan run that he's going to participate in. So with that, please give a very warm welcome to your panelists and your moderator, Barbara Schechter.
I believe we were going to kick this off with some words from each of our speakers on the panel and then open it up to a Q&A, which I will begin. And then we can go to the audience if there are questions there.
So thanks for having me up on the panel today. I want to have most of the time spent on going through some of the specifics around the study. First, I'd like to just talk a little bit about why we did the study. You know, as we have done our advocacy work over the last 4 or 5 years across the country, what was really evident, and we've really ramped that up significantly, what was very evident to us at Advocis was that there was a real lack of understanding of who financial advisors were, how many financial advisors were out there, what did they do for clients, What kind of value did clients receive? How were they structured? Were they business people? Were they employees? And then on top of all of that, what was their overall contribution? Because when you walk into a policymaker's or a legislator's office, as Greg mentioned earlier on in the discussion, there was a significant amount of time that's needed to provide a clarity as to what our industry is all about. And you know, they're challenged by the next group that's coming in. And so from our perspective, we really felt that it was important as the Financial Advisors Association of Canada to really put forward a credible piece of research that really started to define various parameters around what financial advice is and how clients benefit from financial advisors. The other thing that's really important to note is that this study really started about 3 years ago. When I went across the country with Greg and with others on the team, you know, speaking to various executives in companies, we'd always ask, you know, how many advisors do you have? How many advisors are in the industry? You know, what's going on? And you'd get different perspectives. You'd get different viewpoints. You know, there's 100,000 advisors out there. There's 80,000 financial advisors out there. There's the 80-20 rule, you know, 20% of the advisors do 80% of our business. And so what we were left with thinking is that we need to kind of quantify some of that. And so what we did is we went to investor economics, and I know a number of the companies represented here do use investor economics to do various pieces of research for them on our industry. And really what we started out with was an economic profile, sort of who the advisors are, how many are they, where are they licensed, and how do they essentially set up here in Canada. And that work was done in 2011. So we released some data, and perhaps some of you have seen some of the data out there that Investor Economics goes out and presents. Well, that's work that we initiated because we felt very strongly it's important to really understand the nature of the financial advice industry in Canada. But we didn't stop there. What we then wanted to do was we wanted to take it much further. And so while this is a PwC study, what's going to become evident is this is a multidisciplinary approach that we took. We brought forward professionals from investor economics, from PricewaterhouseCoopers, and from HDR to really put together a piece of work that we think is helping us define our industry and actually for the first time carve out the small business financial advisor sector within that. And why is that important? Because I think it's really important for people to understand that these are business people. These are entrepreneurs. They're hiring people. They're in the field. They run businesses. They pay rent. They do all those types of things, and they provide financial advice to a wide range of consumers. The other question really that we were trying to answer in all of this was, you know, who benefits from financial advisors? What portion of the population is really benefiting from access to professional financial advice? And I'll allow these gentlemen to really talk a little bit about that because that's really part of the study. The other thing that we really wanted to look at is, you know, when we traveled across the country talking to either executives, regulators, advisors themselves, one of the most fundamental questions they have is, where is regulation going? What are the compliance costs? What are the issues? Where is all this coming from? So that was the other question that we really wanted to drill down in and talk about. And I think at the end of the day, what we've tried to do is we've tried to add a different component to the discussions that are happening in the industry today. And one of the fundamental components is what is also the economic impact that the financial advice industry is having right across the country. And that really has never been done before in the way that it's been done with this study. What do the numbers look like? There's so many financial advisors out there. They're making an economic contribution. And what that does as we package the whole thing with this multidisciplinary team and the final product that's been put out there is it really adds a different component to the discussion. And the component is that this is intended to inform public policy. Right? The debates that we've been hearing and the discussion, I think, up to this point in time has really largely focused on the regulatory component. And the regulatory component is that you've got a group of regulators that want to protect consumers. But they also have another obligation. And that is, for example, in securities, the efficient operation of the capital markets. Well, what we've seen is a little bit of an imbalance. It's all about consumer protection and a little about how the market should be operating efficiently. And so what we're trying to do is we're trying to add this component to the public policy discussion. And what this study really does, from my vantage point, is that it brings new information forward that allows public policymakers to see that there will be and should be some decisions made based on the full picture. Not just on the consumer protection issue, not just on the regulatory issue, not just on the changes that need to be done in the industry, but also what is the impact to governments, to the economy, to the end consumer. It's not just an impact on industry. And that's an extremely important component that this study really brings to bear when you look at it in its entirety. And so really that's what we were trying to do. And I think we've really been successful in putting together a very effective team to kind of deliver that kind of advice. And as Robert suggested, it really benefited from the depth and the breadth of a very professional team of consultants that we put together. So I'll leave it at that so that we can spend a significant amount of time really going through what the study really found and how it was conducted. But I just wanted to start with that just to give you a bit of a perspective of what it is that we did, why we did it, and what approach we wanted to take and what, at the end of the day, outcome we wanted to achieve.
Thanks, Peter. So we really limited this to what we defined as the small and medium business financial advisory. So that is independent advisors, that's advisors that work for even an exclusive agency system, but they're out on their own, paying their own bills, whatever, MGAs, mutual fund dealers. But we excluded from the study big, giant, multinational corporations such as the banks. And it wasn't that we didn't want to include the banks in there, we wanted to get a handle, as Peter said, on what's the economic impact of the independent organizations out there that are supporting financial advice. Who are they? What do they do? And how they do business and what's the economic impact. So we did a tremendous amount of research over a period of about 3 months. And if any of you have seen the report, the last 5 pages are a font 6 bibliography that goes, as I said, 5 pages of literally hundreds and hundreds of documents that we cited in the report. But to get to those 100 documents, we actually reviewed literally thousands of documents around the world and spoke to people. We then did an online survey of advisors and got a tremendous response from that. Over 2,000 advisors participated in that, as well as distributors. And so we got a lot of good demographic data, how their practice is built and so on, and we'll share some of that with you today. So it was a very extensive piece of work. It took us over elapsed time, about almost 6 months, I guess, Peter. So we were pretty proud with the result, and hopefully that, as Peter said, it'll have an impact on things. So looking at the advisor then, what do they look like? Where are they located, and so on? So if we look at the responses we got nationally, most of them were from advisors. 1,700 of the 2,100 were actual advisors. We did 27 branch managers, but we actually excluded them from the analysis. It just wasn't enough to do any in-depth analysis there. But we did get 87 independent distribution organizations, MGAs, investment dealers, and so on, that we're able to do a fair amount of analysis on. And as well, the responses we got were very, very nicely split across Canada, a little overweighting in Ontario, a little underweighting in Quebec. which we did some drilling down on actually, and discovered that there was some reasons why I was underrepresented, because the number of advisors there per capita are actually lower. So some interesting insights came out of that as well. But basically, if you look through what we looked at there, ignoring those big 6 banks and credit unions, we actually got information about 80% of financial advisors across Canada. So a very good representation there. And if you look at who we actually spoke with, they really broke down into 3 broad categories. So you had IROC licensed advisors, MFDA advisors, and then insurance-based advisors. Now, insurance-based advisors was a tough one to come up with a definition for, because if I'm an exclusive agent at say Freedom 55, am I insurance-based, or even if my practice is 95% mutual funds through Quadris, am I an MFDA guy or am I an insurance-based advisor? So we had some definitional things that were challenging to work through, and some of the counts of advisors there. But if you look across the top line there, we end up with just around 80,000 licensed advisors right across Canada, servicing a huge number of clients, somewhere around 18 million customers. Now, it doesn't mean 18 million unique customers, because there's duplication in that. You may be dealing with an insurance agent on one thing, a mutual fund or IROC guy with another, and maybe I've got some mutual funds at a bank branch somewhere. So that doesn't mean 18 million unique consumers, but it's impacting right through there. What was interesting, though, if you look at how these advisors build their practice, it's quite different in their makeup. So if you look at, for example, IROC advisors tend to have just over 300 clients on average, where an MFDA advisor only has about 229, and insurance-based advisors is the lowest of 172. Equally, and this lines up with the licensing profiles, is the assets per advisor that they're working with on their clients is dramatically different. Okay, if you look at the insurance-based advisors, on average, only $2 million. Now, we all know advisors who've got much bigger books than that. That's not the issue, but there's some that have almost next to none. So again, MFDA, you'd expect more. It's 4 times with the insurance-based advisors, 8 million. But then you jump to financial advice dealers, and it jumps all the way to 35 million. And just for comparison, if you look at the non-big 6 financial service broker dealers, then it's $50 million per advisor. So where I'm licensed, where I focus my business, has a huge impact on what my business looks like, obviously, okay? Which these things make sense. If you look at life coverage per advisor, though, and this is some interesting numbers here, is you'd expect that the insurance-based advisor would have a good coverage level for their clients. And they do. The average number of face amount is around 26 million. Where if you look at the IROC advisors, there's much less of them, the smaller cases, but it moves all the way up to the $19 million level, even though these people have only been doing insurance for, in some cases, only a few years and so on now. So the numbers are quite different all the way through here. And one of the other things we keep hearing all the time is the graying of the financial advisor population in total. If you look at the average age groups, both IROC and MFDA advisors are about 45 to 55, but 54 rather, whereas the insurance advisors tend to be guys that have hair that looks like mine, okay? And so it's definitely an older group, but it's weighted to older and the insurance-based advisor in that. And then finally, if you look at revenue, it does vary quite a bit. And again, with no real surprise, the IROC-based advisors' revenue is about $100,000 on average more than an insurance-based or MFDA-based advisor, and that's dealing with larger assets under administration, larger number of clients, and so on. And then the final point I'll make, which lines up perfectly with the age demographic, is that insurance-based advisors tend to have been in the business a long time, and the median is over 20 years. So what that speaks to as well is where's the new blood coming from, right? If the median is over 20 years, where's the 25-year-old, where's the 30-year-old? How do we get new advisors into the overall industry going forward? So looking at some of the findings there just quickly on those advisors on that, it is an industry that's traditionally male. 76% of advisors out there are in fact male. The dual licensing is the norm, and that chart number 2 there talks about basically 70% being dual licensed and the rest being 30%. Again, because of that definition that we were talking about before, there's some overlap there, so actually it's probably even more than that. We think probably the number is more like around 85% are dual license. So dual licensing is the norm. And if you look at the duration in the business, depending on my licensing orientation, you get a different picture, okay, of how it works out. So mutual fund advisors tend to be, a smaller number of them are new in the business, which again speaks to what's the entry point to the industry. Securities licensed advisors tend to be more on the younger side. So what's interesting is look at the revenue numbers as well. There's a lot of advisors out there, 60%, who have revenues of less than $100,000, and of that, 20% is actually less than $50,000. And yet there's 70% of advisors are actually under the 250 mark. So one of the things you hear sometimes in some of the articles that are written about advisors and the fees and so on and so forth, by and large, this is not an industry where people are making a whole lot of money, okay? These are not bad incomes, no argument there, but it's not that all the advisors are getting rich from the huge fees that are being paid, all right, huge commissions on that. This is a reasonable compensation for a reasonably well-educated and professional set of advisors on that. So important factor there. Yes, there's 30% making more than 250, but it's only 30%. So one of the things we looked at is what these individuals do, whether they're in the business for 1 year or 20 years, and we came up with a really common set of things that they actually do out there, okay? The small medium business financial advisor deals with a wide range of clients, all the way from mass market to high net worth. The dual licensed advisors provide a hugely broad product range, mostly from an open shelf of some kind, whether they're dealing with an MGA or dealing with a mutual fund dealer, very broad shelf, and so it can bring a lot of products to bear. Study after study shows that their integrated approach to fulfilling client needs leads to an impact on their net worth. And there was some references made this morning about, I think Gary mentioned it on one of the studies here in Canada, there was assets were about 3 times with advice that they were if you didn't have advice. So they deal with a broad range of people, they deal with an open shelf of product, they understand what the client's goals are, and they have an impact. So this is the common theme, whether they're IROC licensed or insurance licensed, 5 years in the business or 20 years in the business, this is the role they play in the marketplace. So with that, I'm going to pass it over to Dennis and have him talk about the work these guys do. What does it mean to the economy?
Okay, thanks, Byron. One thing organizations like to have before they go out and study and tackle various issues that are important to the industry is really to provide decision makers with some perspective on the significance of their organization or association or entity on the overall economy of the country. And they do that by looking at essentially, what is the jobs impact, how many jobs are in the industry, and how does it affect the economy in means looking at indicators such as gross domestic product, which is obviously the most common measure of economic activity in the country. So what it really does is it frames the significance of the organization, puts it in context of the overall economy, and I think it's a very important first step in moving forward with various initiatives. And so that's what we were brought in to take a look at, is to get a sense of the small and medium business financial advice industry and what its contribution to the overall national economy is, as well as provincial economies. When we look at economic impacts in this domain, there's sort of 3 main components that are traditionally examined. One is what we call the direct impact, and that would be the impact of the advisors themselves, the compensation they receive, and the employees they hire. There's also a spin-off effect, though, that's important to look at, and that's really the impact on the things they buy, whether it be information technology products, supplies, etc., but that's a spillover effect which impacts other industries as well. And then there's the induced effect, and essentially there we're really focusing in on what's the impact as people receive wages and salaries through these activities of financial advisors. That ripples through, and the folks receiving the wages and salaries spend them as well. And so there's this ripple or multiplier effect as well. And as I mentioned, metrics consumed are essentially sales, GDP, employment, and that's what particularly we've looked at in this study, looking at the small and medium financial advice industry. Now you may ask, why don't an entity such as Advocis and other organizations just go to Statistics Canada and collect this data. Well, obviously the data is not that customized, and it actually takes a fairly large undertaking to go out and explore the appropriate metrics for the industry. So in this slide, I've really talked about the findings, but on the left-hand side, I think it's worth to spend a minute and talk about the approach we took with our partners here at PwC. Fundamentally, without a strong and robust approach, the findings at the end of the day don't necessarily mean anything. So we really went through a deep dive here to make sure that we had an approach that was robust and to generate a set of estimates of the economic impact that could be robust in terms of various stakeholders looking at them. So the first thing we did, as Byron discusses, we defined what the target market was, the small and medium business financial advice industry. And once that was defined, we actually created a survey so we could reach out to everyone in the industry and collect their feedback on their operations, basically how many people they employ, where they spend their money, things like that. And the key thing about developing the survey, again, was to make sure it was parsimonious, so when someone got it, they didn't realize it would take them 2 days or 2 hours to fill it out. We wanted to make sure we got enough responses to have a robust set of results. So we made it parsimonious to do that. Then we collected the survey responses, and we got about 2,000 responses in total. We went through each of those responses one by one, picked out any anomalous data, things that sort of didn't make sense, did some cleansing there, did some double validation, and worked with a cleanse set there. We then went to Statistics Canada. They do input-output modeling at a very detailed level, and we collected the information from those models that we could apply to the expenditures being made in this industry. We developed the economic impact model, and then based on the survey results, we translated that to the industry. And we got a set of numbers that, you know, to be honest, at first blush were bigger than we would have thought a priori. But we went back, we looked at Statistics Canada information, other reports that have been done on the industry, and the results actually made sense when we did the final analysis. And the core findings, well, the small and medium business financial industry is a key sector of the Canadian economy. If you include the spin-off or ripple effects, we're talking about 1.4% of the national GDP of the country, which is quite significant. If you look at various industries that sort of make the national news, or you have various experts in talking about things when the economy may be going through a bit of a slump, you know, it's bigger than the pharmaceutical industry, aerospace, and motor vehicle manufacturing industry. So it is a very significant industry. And if you look at it in the context of the finance industry itself, you know, the small and medium business financial sector is a key component of that. And depending whether you look at it from an employment perspective or you look at it from a GDP perspective, it's anywhere between 15 to 20% of the total finance industry. So very significant. And I think the thing that's key about this as well is that the impacts are really broadly distributed across the country, and not just in sort of the large urban centers, but in the smaller regions and smaller municipalities right across Canada. And that's sort of unique, because typically when we do these studies, we find impacts that are very concentrated at a specific urban or provincial level. But here I would say one of the key things that we found in looking at the results was that they were dispersed pretty broadly, both across the country and then within the provinces. So when we get down to it, and perhaps I'll focus on a couple of key impacts here, but and this looks at the results for the sector in total across the country. And of course, as I mentioned in my previous slide, you know, I've got the results split by the direct impact. That's the impact of the advisors themselves and the people they hire. The indirect impact, their spending on supplies and services, and the induced, what happens with the ripple effect as salaries are spent. But if you just look at the direct impact, and you think of the Canadian economy of about $1.9 trillion, the small and medium business financial advisory industry is $19 billion. That's enormous. I mean, it's about 1.1% of the overall Canadian economy. And if you look at those spin-off or ripple effects, if I could call it that, it's actually 1.4% of the Canadian economy. And from an employment perspective as well, you're looking at employees in this industry of about 182,000 people from a direct perspective. And again, that's about 1% of the entire Canadian economy. And I think in looking at these types of numbers, it's also important to note, especially when talking to government agencies and regulators, is the significance of the tax revenues generated by the industry and the amount that are paid through taxes throughout these various impacts and the wages that are collected, et cetera. And we see if we combine everything together and look at the direct, indirect, and induced effects, we're talking over $6 billion a year in contribution to government coffers, which is, I think, an interesting and key statistic in terms of those conversations. This slide is really just to highlight what I mentioned previously. And so if you look at the impact of the industry, the small and medium business financial advice industry, from a direct impact perspective, we're over 1% of the Canadian economy, whether you look at it from a GDP and employment perspective. And if you look at the other sectors that I mentioned here, and this is sort of some of the common industries that you would see mentioned, the industry is larger than many sectors, as I mentioned. And in terms of the broader finance sector, which is obviously a very large component of the Canadian economy with the major banks, you can see that this particular segment of that sector is quite significant as well, at 15 to 20%. When you look at the regional aspect of the results, we did summarize the impacts down to the provincial level, with the exception of Atlantic Canada, where we combined the results due to the number of survey responses. We wanted to make sure we had robust estimates for each level of categorization. But what you see generally is that overall, the impacts across the country are dispersed similarly to the way population is represented across Canada. There are some exceptions where there's somewhat of an underrepresentation as Quebec, as Byron mentioned, and a little bit of an overrepresentation in Ontario and British Columbia. But more or less, the results are spread across the country, as you might expect, just looking at population numbers. From a key operating statistics basis, when you look at it by jurisdiction as well, the results are fairly similar and robust. But I think some of the key things you do see is that on average, per each advisor, the advisor generally has another 1 to 2 employees. The average per advisor is about 2.2 in total. And if you look at the direct employment across the country, again, it's over 180,000. And if you look at gross domestic product per advisor, you're in the $235,000 range. So, if you think of it, and I think from our analysis we found that about 30 to 35% of these advisors were sole proprietors, but there was a lot that had 2 or more employees. So really, if you boil it down per overall employee and per advisor, the number is 235,000. I think that aligns up very nicely with some of the commentary Byron was indicating earlier.
So just to talk a little about who these advisors serve, and again, as part of the study, we looked in depth with some of the segments that are out there and gathered a lot of good information on that. So this morning you heard from a couple of the speakers about this potential for the mass market having a bit of an advice gap. So I thought it was important. We had quantified that in our study as well, so we wanted to speak to that just a little bit as we go forward. So if you look at the market out there, 80% of Canadians would fall into the mass market group. In total, they control about $320 billion in assets. But the definition of this is under $100,000. So these are everyday consumers with modest RSPs and whatever they've got. These are investable assets. If we move to the mass affluent segment, which is a very attractive segment for a lot of businesses, it's only 12% of Canadians. And here we got assets of $100,000 to $500,000, but that's $408 billion. So what's interesting there? It's only a third bigger than the other one, than the mass market, and yet it's only a seventh of the size of people. However, the industry, and this is a trend we're seeing with the regulation changes around the world, is focusing more on an affluent market who can afford to pay for advice, and it has more interesting challenges that advisors like to work on, both from an intellectual point of view, but also from a monetary point of view. And we look at the affluent consumer, which is 500,000 to 1 million. It's only 4% of the population, and yet it controls $444 billion of assets. Huge. And then the high net worth, also about 4%, is over $1 million, and that's $1.9 trillion. So clearly, follow the money, right? So advisors will go to the $1.9 trillion pot right before they'll go to the smaller pots that are out there. But what are the needs of the mass market? The mass market we looked at a lot of characteristics about them. What do they need? What do they do? How do they get advice? They seek help. Because they're not necessarily familiar with what's going on here, they're less trusting. They don't have an advisor that they've worked with for years at a time, and they're unsure what the next step is, so they are a little bit less trusting. They need, if you will, a starter relationship in order to grow. And they have some misperceptions. And one of the perceptions is that they believe that you need at least $50,000 to even talk to an advisor. So if I'm a starter investor, if I'm a young person just starting a family, whatever, I don't have $50,000. So how do I get going? How do I even amass the first $50,000? So there's a bit of an issue out there that's really important. When we move to the mass affluent segment, they've already got going. They've already got assets. They're over $100,000. They own more products. They are more in charge of what they do. They take control of some of their decisions, much more so than the mass market. They have different set of concerns. They're concerned about retirement. They tend to be a little older, obviously, because they've had time to accumulate the money, but now they're looking forward. They are concerned about retirement. And they seek advice, but they also seek validation. They make up their own minds in many cases. They do a lot of research, but they seek validation of what they've discovered. Am I on the right track? Does this make sense to you? That type of thing going on there. But what's really interesting is those two segments, the quote bottom segments, over the next 10 years are expected to grow by $263 billion in assets. So there's a lot of assets out there waiting to be managed, to be have advice given on, and it's a really good potential market. It's just as discussed this morning, how do you get to it in an economic manner and go from there? So definitely interesting there. The advisor, and this speaks to where maybe part of the solutions are, is also going through, we see a transformation as they try to deal with some of these segments. If you think of the traditional advisor out there, it's very much relationship-based. It's one-on-one, face-to-face, traditional classic reaction, but more and more digital's coming into it, okay? And so we see most advisors today are over on the right-hand side of this chart, where a traditional advisor starts to get digitally enabled, uses technology, has their own website, can communicate via various social media mechanisms, may even use things like we saw today with Anthony from Australia with Skype. Don't have to be physically face-to-face. They can be face-to-face through technology, and starting to embrace technology to some degree. A few advisors, but we see this growing quite rapidly, are moving to what we're calling a social advisor. So now they're really embedding technology in their practices. They embrace technology, they utilize it, they're providing their client base with tools, with ways to interact with them and so on, and it becomes much more of a collaborative affair. And most advisors today are somewhere over in that box 2 or 3. And that's important because part of the answer to that advice gap is, where do I get information? If I can't get it from you face to face because you're either not there or you've moved up scale, this is an opportunity. So the whole digital advice things, and then we can move one step further to the fully automated advisor, and there was some phrases used this morning like robo-advice and things of that nature, and we're not sure how far that one's going to go, right? How far that's going to be embraced. Like, where do I stop with digital and need a live body to actually talk about that? So part of the answer is digital, and that's the good news, but it also means that the advisor, as was talked about earlier today, needs to change. Right? They need to understand their new business model. They need to understand how they're going to interact with their customer, and how technology is going to play a part in this as all this stuff changes that we've been talking about all morning.
Just to continue what Byron was saying, we're seeing evidence now of some of that shift beginning to occur globally, but here in Canada as well. A lot of you know self-directed investing. The robo-advisor concept has been around for some time now, but in its basic form, it was mostly focused on more the back office transactional arenas, and a predominant focus on ETFs as well the last few years. But what we're beginning to see now is what they're calling, so we've been in Robo 1.0, let's say, for the last few years. We're beginning to see the advent now of what they call Robo 2.0, which is a much more diverse, comprehensive, and holistic way of engaging with clients using cognitive computing. So I don't know how many of you have heard of IBM Watson, but the development and the innovation that they're being able to create has allowed for companies like Charles Schwab, BMO on the Vice Direct channel, to a certain extent CIBC, Imperial Services, to interact with customers like they haven't done before. And so it was interesting, previous colleagues had mentioned, when you think about advice, traditionally in the model, it's usually engaging face-to-face. There's always got to be a touch point. But over the last 10 years, a lot of that's changed. And so it's not a replacement, it's not a revolution, but we certainly believe we're seeing some incremental evolutionary pieces coming in, and it's being adopted very well in the retail sector, in travel, as Rod had said, in the music, video, movies, to what extent it'll happen in our environment, other than the fact that we're seeing it in the auto and P&C side of the insurance channels, is still kind of up in the air, but they're definitely making more progress into the space. So then, when we look at that, the changing customer behaviors, when we look at their expectations and how that's changed, they no longer look at financial services in a fishbowl, separate from everything else. If they obtain experiences and an engagement model in other industries, they would expect the same consistency and value proposition within the financial services world. When you combine that layer with the Canadian regulatory scene, and we're not going to go through the details because we've spent quite a bit of time talking about the different regulations, but a more informed customer, right, in combination with the other expectations behavior is what we're evolving to. CRM2 and point of sale are going to provide customers with more information they've had before, whether people like it or not. I mean, that's the overall intent, is to have a more informed customer. But there's tremendous opportunities within that environment for advisors, for all of us, to be able to dispel and to distinguish what that value proposition is. And we'll discuss that in a little bit. But the one angle on the regulatory side, if I can context a little bit from a Canadian perspective, is I think we've beat this down to the point where everyone's getting tired of talking about how much regulatory change do we need to be able to enhance the customer protection, the customer confidence question in Canada. When you look at sort of the balance between customer protection and customer confidence versus accessibility, there's a definite gray line that's being formed. And what I liken it to during my experience in the golf industry is they're asking the advisory channel now to open up the Walmarts of the world, be very price conscious, and make everything available to the group. But what the issue is there's no infrastructure to allow for the advisors, if you will, to be able to grow into the Walmarts. Right? You're still, as you looked at the numbers, the majority of the accounts and the portfolios have between 200 to 300 clients, and that's the same in the UK. It's the same in Australia, and a lot of that isn't just the business aspect of it; it's also the regulatory, right? And it's very layered, it's very intense, and hopefully we'll make some headways there. So the true challenge for both the industry and the regulators is how do you find that balance? Because to us, accessibility is making it available at a low cost to a multitude of customers, particularly at the low end of the mass affluent and emerging spectrum. And that's where the crust or the core of the population currently sits. So that's really where you need to frame the go forward around where the world is heading upscale, what happens currently right now, whether you believe there's a gap or not, and how do you think that's sufficiently addressed, whether you're a regulator or you're part of the business. Again, I won't spend a lot of time on this slide because for those of you that aren't familiar with what's going on in the UK and Australia as well as the US, there are some brief descriptions and overviews on some of the topics discussed today. But I think what this points out, and it's more of a non-regulatory implication on the impact to advisors specifically. So there has been a lot of talk of the reduction of the number of advisors as a result of the implementation of RDR for a number of different reasons. What I think it really does lead to is the challenge that advisors have faced today with redesigning their business model. And it doesn't always have to be related to the regulatory aspect. Consumer behaviors are changing, products are changing, the business is becoming more commoditized, at least on the fund side, whether you believe it or not. And the more simplification they introduce with products today, the more commoditized things get. And at the end of the day, the channel doesn't matter anymore, as we've seen with travel and music and video. If the customer feels they get the same experience, regardless of the channel, and the value proposition is defined easily for them, they're going to buy. So the question there is that, despite the regulatory pressures and challenges do exist, the real question is, how do advisors, how does this group, and as well as your colleagues across the country, position themselves, considering both the regulatory and the more strategic consumer-based implications? So that leads us to sort of that summary, and I think when we listen to all the conversations that occurred today, there are really three key themes, I think, that emerge. And one, obviously, is the opportunity, and we really do feel that you can present this as an opportunity for you and your business to present yourself as a trusted advisor and really define what that value proposition is. And it could take very many different forms, but I certainly believe the basic litmus test and the acid test that Rod had mentioned before, as well as my colleagues here, is anything that you feel is commoditized is your starting point. Right? And there's a lot of different aspects to the services that you provide, whether it's the discipline, whether it's education, whether it's literacy, elements that you can provide. But just keep in mind and keep your mind open about what a true commoditization is in your service and how you differentiate yourselves. Because regardless of where the regulation goes, the wave in terms of changing consumer expectations is going to continue. That, however, is also going to, the success of the advisor community as well as the industry in general is going to depend on how flexible and malleable the regulatory environment is going to be. So that Walmart versus the boutique versus small town businesses come into play here. If you're going to regulate and ensure that you protect the customers in terms of their confidence, in terms of their overall well-being, you also want to make sure that you're providing them with the access. And while the robo-advisor in the digital age isn't going to go anywhere, there's still plenty of people who had specifically stated that they want a relationship, that they want to have both, which is what the markets seem to be moving towards today. And how do you overcome the issue and the barriers around the number of clients that you currently service going forward? And the advantage that you have with the robo-advisor platform is that it's designed to be scalable. That's the whole point, right? The cognitive, intuitive interface that they're building right now is supposed to help address some of the KYC or the suitability and other transparency issues. The question is, how does the balance occur and when does it occur in discussions with the regulators? And that really moves into third, business model innovation. And the question that a lot of advisors ask themselves is, how ready am I to make a change? How ready am I as an organization? How ready are the asset managers prepared to make a definitive change to help build for the future and make sure that we're prepared to address whatever gaps or issues we see going forward?
Okay, well, I'd like to start off just by delving a little bit into the study itself, what prompted it and how it's been received. And just given what you've all said, it sort of popped into my mind that it reminds me a little bit about what I've heard about the insurance industry and how they have sort of managed to lobby because they're so vast in number, they're spread across the country, they have elected representatives. I wonder whether the study is in some ways sort of a call to arms.
I guess that's a question for me. I don't think I think really what motivated us to undertake the study was we felt that there was a significant part of the information that was missing, right? So that's our starting point. Like what we're seeing from a regulatory perspective is that regulators are driving public policy. I think what we need to do is we need to think of what is the public policy objective. Is it increasing financial literacy? Is it ensuring that people have enough to retire on? Is it ensuring that people manage their risk situations effectively? And if those are the public, and should they continue to have access to a professional that will actually guide them through that? Because despite what I think has been discussed and you hear about, people aren't motivated to take care of their own finances. I mean, that is the bottom line. And so that's what professional financial advisors do. And so if those are the public policy objectives, then you have to reverse engineer. And so in order to reverse engineer, you need facts. You need information about who these people are, what they do, how many they are, what kind of clients they are dealing with, and what the issues are for those clients. On top of that, what are the costs of doing business? right? These are small business people. They're making $100,000, and that's gross of expenses. They have to pay their rent, they have to pay their assistant, they have to pay a whole bunch of other expenses in order to survive and provide the quality financial advice. So I think that's really where we were coming at it from. We felt that that was a huge information gap, and we think that the study in and of itself has provided some valuable information to regulators, to legislators, and to the industry, quite frankly, because that's really what our target was. I think so far it's been very well received in terms of being able to provide that information, but we just felt really that it needed to bring forward that kind of information so that we have informed public policy decisions, so that we look at the issues more holistically and not very narrowly on the industry in terms of regulatory policy.
Do you think there's a connection between the sort of push to ban certain types of compensation and all the pressure and some of the stories that you see about bad advice? And so it goes to that as well. Is there a bit of a double-edged sword, or people in the industry don't want to step forward because of a perception that is out there?
Commission itself is neither good nor bad. If that's a mechanism that consumers can actually access financial advice without having to write an extra check to get started on a program, then that's actually a positive. The real issue around commissions on asset products, in our mind, is more one of disclosure. If you know what you're paying for the advice, you know what the costs are that are embedded in your product, and those are fully disclosed, then why can't you give me the choice of how I pay those? Whether it's front-end load, back-end load, no load with a fee, all the above. Stuck into a wrap account when I pay one master fee. Those are choices that consumers should be able to make. And depending where they are in their own financial journey, they may make a different decision at different times. And in fact, I think people probably do make different decisions at different times. So I think looking at this is what is the problem that is being asked to be solved, right, by the whole question about embedded commissions. I mean, do we have a problem? Is there a systemic problem about commissions cause all these horrible things that we might be afraid of? If they don't, then why are we trying to solve that problem? And if they do, well, let's find out why. But if you look around, the number of examples that are reported each year about abuses, it's very small. It's an extremely small number of advisors in any segment of the industry you want to go to. So does that mean that it works, or does that mean there's a few bad apples, right? And I think regardless of where you are in the commission argument, pro or con, no matter what system you put in place, I'm sure in the UK there's still a couple of bad apples abroad, right? And probably if Anthony was still on the phone or on Skype, there would be a few there as well. So I don't think there's going to be a perfect system that's going to solve 100% of the problems anyways. So let's focus on what problem we are trying to solve. And if it doesn't exist, let's not go there.
If I can just add to that just quickly, actually, it is a very good point, and I think Ian, I believe, had mentioned that, is the question really about compensation, or is it deeper and a little more holistic? But I will say that the CRM2 is designed, obviously, to introduce levels of transparency in terms of the product they buy. The one issue when you talk about accessibility is the fact that the majority of the Canadians don't know how many different fund structures they are of the same type. And so with the introduction of D-series funds, for example, on the self-investment platform, I think RBC now has 330 D-series funds that they're actively promoting in the marketplace, right? So regardless of now whether people believe that you can sweep the fee transparency and all the other different fee types under the carpet, the advent of low-priced products are coming. And so I do believe it's a deeper issue, but on the surface, people are going to start talking about what that value prop is. If you strip out the advice piece and you move into a different avenue, the question then is how do you differentiate, right? So I think the CRM2 piece, as the discussion goes forward, is not necessarily about just that they know what they're buying, but they also know what they're not buying. And they understand fully what the implications are. And I think it's our role as an industry to ensure that information is provided. And at the same time be able to promote actively the value proposition that you offer, because it surely isn't stuck in the products that we sell on a commoditized basis.
It seems to me a lot of the challenge when people talk about this sort of thing, though, is they tend to grab at something simple, and I don't know if you would say that's the politicians or it's whether investors understand something deeper. So the debate tends to be top line or driven by top line. So that's what I wonder how, if you can address how the study and how the things you're talking about, how they fit into that, and how you're maybe getting through to people that are making these decisions beyond a top line.
There was a couple of slides that we had on and that we didn't talk to in detail, but one of them indicated a whole series of things that we called good intentions, and then below that, unintended consequences. A number of speakers today talked about unintended consequences. Again, what is it we're trying to fix? Okay, and you can't argue with things like higher professional standards for advisors, better disclosure, better transparency, better communication, better financial literacy. All those things, everybody in this room, I would think, would say those are good things in general. But in trying to get to those, if you create a whole new problem, then you haven't solved anything. In fact, you maybe have made it even worse. I'm not sure I answered the question.
I can add to that as well. Actually, there's one slide that we're supposed to show you that we didn't, but it's on the rising cost of compliance. So we had some information provided to us in terms of cost of FOFA, some RDR cost information. Currently, right now, when you add up all the regulatory costs, and we're just talking the SROs, the security regulators in Canada, as of year-end 2012, their total spend was about $552 million, just the regulator. Right. So when you hear about the cost of RDR, the cost of FOFA, both from a planning, design, implementation perspective at the operational level, so we're talking head office at the product manufacturers or asset managers, we're talking distribution, and then we're talking the ongoing costs. I mean, we're talking $1 billion plus. Quite
that number is rising at double digits a year, by the way. Okay, so that's not going away. So that's a $50, $60, $70 million rise every year, just on our current regulations. And with CRM2 coming, in its appropriate phases, I think that's going to go a long way to addressing some of the transparency issues that are out there. It's going to have to improve consumer awareness of what things cost and what their options are. But the regulation cost is not going to go down. It's going to go up.
And so, RBR right now, I think FSA was predicting a $2.5 billion pound exposure over the next 5 years. And if you did a business case around the extra step you take to ensure customer confidence and protection and disclosure transparency outside of the KYC and the current disclosure platforms today, versus the additional costs that are incurred, how does that fall out? And who decides at the end of the day what's acceptable to the client? Because they're eventually going to bear the cost. Right? So the whole discussion around fee transparency and cost reduction could be moot if you're stuck with a $3 or $4 billion bill over the next few years.
Good point. So let's pay no commissions at all, but we'll put a $3 billion cost to the industry on compliance. And that won't change the price of the product, will it? Right?
So that's something I think from a top line, bottom line implication that needs to be.
But what the study didn't do is it didn't really measure the cost that the consumer really pays at the end for regulation, right? I think there were some estimates in the UK and Australia in terms of percentage of time that an advisor actually does have to do in order to comply. And really, I think that would be some very interesting future work. Like what we need to look at is really what are the costs of having to comply with a number of the regulatory requirements. So I guess one of the key themes that really have emerged from this work and have, I think, spurred some more discussion is, right, is more regulation good regulation? In our view, more isn't good. More isn't better. Better regulation is better. Meaningful regulation is better. But more isn't necessarily better, because what more does is it takes away from what financial advisors really need to focus on, and that's helping their clients. That's why you're seeing in the UK and in Australia those financial advisors dealing with the clients that can afford their services and can afford to pay the compliance costs. That is a significant outcome of the work that we're looking at and what the study is sort of pointing to. And that's what I say, that's what I mean when I say we need to inform the public policy discussion around these issues, because without that, that's when you get the unintended consequences. And I think we have to think about what kind of future we want for people that really do rely on financial advisors. And that's really where I think the study does some good analysis in terms of where we need to go and what kinds of things we need to think about.
Well, I wanted to ask too, it's a related question about the group that you've highlighted in this study. Does it make sense? I mean, even in that one slide, I think you mentioned MFDA, IROC, I don't know if the OSC is involved. Does it make sense for this group to come under one umbrella or one new regulator that will manage these 1, 2, 3 person shops?
Well, why don't I start? I mean, what we're seeing is we're seeing different regulatory trends happening. We're seeing certainly convergence of regulation. There is discussion about the cooperative securities market regulator under one umbrella. Not everybody's on board. Quebec's not on board. Alberta's not on board. So what we're actually doing is we're complicating the system before we can potentially bring it back to a more reasonable sense. Should we be regulating insurance like securities? So those are discussions and debates that are actually happening. Whether we can get everybody under one umbrella is going to be a very difficult challenge given the Canadian historical and socioeconomic context, right? We've got provinces, we've got jurisdiction, we've got different industries. We're dealing with the same clients, but we're dealing with different things. And so it's going to be really, really difficult to bring that. But I think where, as an organization, we're looking at it from is that financial advice has evolved. It's moved away from transactions and those silos to advice. At the end of the day, the client wants to receive professional financial advice. Shouldn't the regulation move in that direction to look at the professional standards, look at how professional financial advice is being provided, and find that common ground? And I think if we think about where the future is going and what clients want, I think that's where the industry naturally is going to gravitate, but I do think it will take some time to get there.
Just on the topic of centralized regulation, I mean, since I started in the industry almost 20 years ago, it's always been a constant subject matter, whether you're in the business or you're a consumer or in government. But I will say, though, like notwithstanding the economic benefits or economies of scale type arguments, when you look across the globe, particularly from the UK, the US, Australia, more centralized regulators have experience the same issues that we are today, right? So it doesn't eliminate, I think, the root issues and the root topics that we're talking about. Fiduciary in the US is a huge topic right now, and the SEC rules the roost. And they're taking a long time to figure out what their next steps are going forward. So I don't think that centralized structure expedites the decision-making process. There may be an argument in terms of economics or what have you, but there are obviously advantages to self-regulate the SRO structure as well. So that's a philosophical debate you can take outside the room, I'm sure.
Okay, I have to play devil's advocate a little with the study and the folks that are highlighted in the study. There's some concern that these folks are not going to be able to stay in business. Regulatory costs alone could put them under. So I guess my question would be, if they were to disappear, are there not options out there that would pick up the slack? There's discount brokerages, the banks are on every corner now offering this type of thing.
Yeah, I don't think the report is suggesting that, it's the end of the world. I think, what the viewpoint is and the perspective is that there are unintended consequences, and so from a regulatory perspective. But again, I go back to the point around the trends we're seeing in consumer. If the regulators really want to focus on the balance between the cost effectiveness, the optimization, the economies of scale, and accessibility, then they're going to have to play on both sides of the scale. They're going to have to ensure that they're providing or enabling an environment that's conducive for advisors to be able to scale their business so they can offer affordable advice to a multitude of clients. It's going to be very impractical for anyone to expect, whether it's a fee-based platform or even a modified, lower reduced load structure platform, to be able to take care of the same 250 clients at the same time. I mean, it's an economical question. When you look at the economic scale or the demographics in Canada in terms of number of advisors relative to Europe and to UK and Australia, it's a little different. I mean, we have a lot of advisors here. We have a ton, and we have almost double the fund products that they do in the UK. I mean, you got to think about that too. So, is there going to be change? Yes, but does that mean that it needs to be as severe from what we're seeing overseas? No, they're very different philosophical platforms under which it was introduced, and if people embrace what's happening, I think, with platforms and digital technology that's available to hopefully influence the decision makers to open up the channels a bit to allow for the scale, I think it could create a whole new market for them. So,
I agree with Davis that I don't think advisors are going to go away. All right, that's not going to happen, and it hasn't happened in Australia or UK. And even though it's shrunk, the advisors have figured out, they're smart. They're good entrepreneurs. They figured out how to do business and how to succeed and move forward. So that, we don't know where it's going to go here. But I think some of the small steps that have been taken, and I think things around point of sale, CRM2, and so on, are going a long way to help advisors transition their business to be more transparent, in more communication with their clients, and so on. So advisors will adapt. They will evolve. The second thing is, one of the slides I mentioned there was that what services really do advisors provide for their clients? And one of them was they provide a broad shelf of products. So they have open architecture, open platform. An advisor that deals with an MGA and a mutual fund dealer can bring literally thousands of products to the table for their clients. Okay, that's not always true when in what part of your question was, but can't the bank step up? And the answer really is no. And it's not about whether they're capable or not. They could be capable, but regulation says they can't sell insurance in their branches. So the very regulation that it restricts them and being able to provide that broad advice to this broad segment. They can provide mutual fund advice and on their IROC platform. They can provide securities advice, but they can't provide the broad range of service because they're restricted. So it's not their fault. That's what their laws are on that. So I don't think that that's the total solution.
If I could just add one important point to the question, and that's the broad nature of what financial advisors do. Right? I think it's really important to take into consideration, and this is really actually highlighted in the study, is the nature of financial advice, what it is today. We heard from the head of FCAC that consumer debt is at an all-time high. Why? Because Canadians are not disciplined. So the fact that you've got an advisor in the relationship is actually imposing some discipline on your financial planning and your objectives overall. And if we lose that, I think we will lose a significant tool to allow Canadians to plan for their financial well-being. So it's not just about, what kind of products and services can I put in place to achieve that. It's how do I get there? What's the discipline? What's the peace of mind? Why would I want to have a professional in a relationship with me to help guide me through some complex issues as the landscape really becomes much more complex? So I think it's more than just how advisors are being compensated, what kind of standard they need to have in place. We all are striving for quality financial advice, but it's that breadth of what they're doing, and they do a lot more than just get the product to the client. And I think one of the key findings from my vantage point is that study, that the study really emphasizes that part of it. And I don't think we should lose sight of that as we look at what some of the public policy objectives are for Canadians to continue to have access.
Well, I was going to ask you each for an easy fix. That's not what the government or the regulators are currently offering, but we'll save that for another discussion. I just wanted to ask Byron if you just have 1 minute to mention PwC has a new study, hot off the presses. Can you tell us just a tiny bit about that?
I think it was actually just released yesterday, and we actually did the study because we wanted to go beyond what we had done for the Sound Advice report and actually get the consumer perspective. The one thing we didn't do with that report was talk to consumers, talk to advisors, talk to distributors, and so on and so forth. So we went out and we asked consumers a lot of questions about what their relationship was with their financial advisors and did they understand how advisors got paid and all these different questions. So I'll just highlight a couple things for you. 96% of consumers, and there was 1,209 consumers interviewed, 96% are happy with their relationship with their advisor. Less than 5% indicated that they didn't think they needed an advisor. So even though they had an advisor, less than 5% said, I can do it on my own. So 96%. 77% said, I understand how my advisor gets paid, which was a really interesting number for us. We were quite surprised at that. However, only 36% said, I understand all the options that are available to me. I don't understand necessarily all the different ways I could buy, for example, mutual funds. So there's still improvement to go there. So they understand, they don't begrudge what advisors are being paid, but they probably do need some more information about options that are available. And that goes back to the transparency issue we were talking about before. So
I would still want to give them a tiny test on whether they really did understand how they were paying.
I would agree.
Thank you all very much, though, for participating today.